this one concept changed how I see every chart. And if you understand this, you don't need 10 indicators. This pattern you are seeing here is a real chart example. And I'm going to help you to be able to understand it, not in terms of pattern, but in terms of logic, using liquidity and structure. So if we look at it here, we can see that we have a very high here that led to this low being taken out, and then we created this low. This low becomes valid after the high has been taken. If the high is taken out, this low now becomes valid. But after the high is taken out, we are having one thing to do, to be able to identify the liquidity. From this point, you have to ask yourself the low that caused the break. That becomes your liquidity. So this low becomes liquidity. The market is going to what? Come take that low out and then move up again. But until this low is taken out, when this major low is taken out, then this is where you have the structure to shift from bearish to bullish, because a major low is now being taken out. So from that point to, you have to ask yourself a question. What is the highest high that was created before that major low was being broken? If you trace the price all the way up, you'll find out that this is the highest high that was created. And then you ask yourself again, which high led to the break of that major low? Is this high? That high becomes liquidity. The market will find its way, travel all the way back into that liquidity. After the liquidity is being taken, that is it, market will travel all the way down. And this low becomes your major low because it took out the liquidity from that high. And you wait for market to break it again. And then you have another true trading range to be able to trade from. So from this, you can see that we can have the structure to look like from here to here. We had a trading range to trade from this point, and then it failed, came all the way down, went all the way up again. So we have this as our major highs that we can be able to trade from. Let me show you this in the charts. In this chart here, we can see price has just move to the upside and then to the downside. It's very difficult to mark the highs and lows if you don't understand what I am telling you. So let's get into this using what I have just told you. So let's understand this. From here, we start to mark this high. Why this high? And you can always start anywhere as far as that high has been able to what? Take out liquidity. You can see that it has taken this liquidity from the downside, and then it created this low. So this low only becomes valid after this high is taken out. If that high is being taken out, you need to identify where your liquidity is. You ask yourself which high has led to this, which low rather has led to this high being taken out. And this is the low that led to that high being taken out. That low becomes your liquidity. So you want to mark that as your liquidity and then wait for the market to trade back into it. Now, the market came and traded back into it and use the major low that you marked here to trade all the way up. But something happened. The market did not trade through. That means that we had a reversal. So the major low you identify was being broken. After that low is being broken, you want to ask yourself which high caused that break. And this is the highest high that was created before the break happened. After the break has happened, you need to ask yourself again which high has caused the break. That is going to be your liquidity. You can ask yourself like which high has caused the break, or which high was recently created before the break happened. It's the same question. So this is the high that was created before the break happened, or it is the high that caused the break. You are very interested in that high because that's where your liquidity is lying. Now this becomes your high, and you need to identify your major low. And this low here becomes the major low because it has taken liquidity from all these highs and then the major liquidity we are looking for. All now you have to do is to look for an entry confirmation here and enter a trade, or you use liquidity itself as a confirmation for entry, and you could enter that trade here and have your first target to be the major low that is created here, and then your stop should go above this high. Why? Because you can see that it also took liquidity from this high here, hence that high can be able to what? Hold price to trade to the downside. And after it has hit here, you can take your first TP or go to break even and allow the trade to run to the downside. And this is how you mark your major highs and then your major lows and your liquidity. So this, after this low is also being broken, then you can now mark this high as a major high. So as you can see, price has just printed the same thing as I have explained to you in the drawing, and this is the same exact thing that it is doing. It picked this high, we take this high from here, we came down, then before we break this high, we created a low. This low is the one that caused this break, and price went all the way up by creating these small highs. Now this low here also became valid after a high, also became valid after it has taken this low and then this low and came all the way down here to respect this major high. After that, we came down and created this low here, and you are interested in the lows that has the highs that has caused the break, and then you are interested in your major highs and lows that you have marked, not this low here. This is the low that is very important. Now we broke it. After we have broken this low here, you are interested in this high that has caused the break. You wait until price trade back to that, and then you have your entry there. If this helps you see the market differently, follow me for more real trading insights. I will be dropping more videos on liquidity and structure.